It is February 3rd, and it's our second Monday in a row with a pretty red board out there. We got Bob Morris talking to us about energy, and he's got an idea that has something to do with the tariffs. So we got Charlie Peabody coming to us live from Denver before he goes and hits the ski hills. He's going to give us a couple thoughts. And I will talk a little bit about this market as well. Let's get going. Charlie, what do you think here? We got a pretty red board. Banks are down. Everything's down except for bonds and gold today and vol. What are you thinking?
No, let me start off with gold because I've been buying gold since December, and you may not remember this, but in the December FOMC meeting, Powell was asked about whether Bitcoin and crypto would serve as a competitor to the U.S. dollar, and he said no, it's not. It's digital gold, and I remembered that he made that same sort of statement back in March of 21, and I used that sort of analogy to suggest that you wanted to fade Bitcoin in December as it moved over 100,000 and buy gold instead. Because that's exactly what happened back in March of 21 when at the BIS conference, he talked about, Bitcoin and crypto being a digital gold. And if you remember in March of 21, after he made that statement, crypto rallied for about a week and a half, and then literally had a 50% correction going into the summer of 21. And I think that's where we're headed with Bitcoin and cryptocurrencies again, that you're going to see this is a risk asset and this is going to fade. It's going to drop 50% from the $100,000 level. In the meantime, I think what you'll see is that gold will rally, and that's where I'm putting my incremental dollars. And I really liked the action of gold last night. It started down 20 or 30 bucks early evening last night, as everything sold off. But by this morning, it was up. So that kind of action is really, I think, very constructive. So I think gold is going to 3,000. Anyway, I wasn't intending to talk about that, Ben, but since you mentioned gold, I just thought I'd throw that in. I think gold is the place to be going into the springtime. Ben,
I would concur, and anybody who's been a subscriber or watches our show knows I've been an ardent bull of gold. My main pin on my Twitter page is I wrote a long Twitter thread about buying gold, and it was time in October of 23, and I maintain that it's still time to own gold. Gold is for chaos, and you know what we have right now, my friends? Chaos. Anyway, so what else you got, Charlie?
so also on Friday, I've had this theme since August that things that need to be financed will disappoint, and things are, things like boats. So that's Polaris and Brunswick Corp, or motorcycles, that's Harley Davidson, or RVs, that's Winnebago, or home builders, and that's been really the heart of the theme is the home builders are going to continue to disappoint. And the big problem there is one of affordability, and you can see from the chart here, was put out by Beazer Homes on Friday as part of their presentation, and they highlighted affordability as still a continuing problem that they face, and it's requiring greater incentives to move product, which means gross margins come under pressure. I just read this from the Beazer Home highlight. Although home buyer affordability is likely to remain the key challenge throughout the year, we are optimistic about the longer term outlook for new home sales and our growth prospects specifically. And I'll come back to that because I want to talk about the outlook. But then he goes on, it's important to acknowledge that we did miss our sales and closing guidance for the quarter. The stock was down 20% on Friday as a result of those misses on guidance. So it's something that goes on to say something we're not accustomed to doing. I'll tell you what happened and what we're doing about it. On the sales side, the strength we experienced in October, with paces up sharply over year, the prior year, softened in November and became materially weaker in December. So as the quarter progressed, things got worse, is what they're telling you. As a result, we sold fewer homes and had to spend more on incentives for the sales we made. While our first quarter is our lowest volume quarter of the year, it is also the most difficult to predict because it occurs during many other home builder year ends when they're obviously trying to move product and increase incentives. Unsurprisingly, the most challenging markets were in Texas and Florida. And that's what we're hearing a lot about now is how the inventory builds in Texas and Florida is creating real price weakness. So he goes on to say, in Texas and Florida, where there's higher inventory levels led to sluggish sales and more aggressive incentives. So the general theme there is that inventory is building, affordability is still a problem, orders are shrinking, and incentives are increasing. So I think that the home builder outlook remains very, very poor, and I still think while we're getting big downdrafts in stocks. I mean, I mentioned Beazer was down 20% on Friday, down another 3% today. We're starting to see we're getting close to a washout level, and bounces can occur in these bear markets at any point in time, and you can't rule that out, particularly if Ben's interest rate projections are right. That should take some of the pressure off affordability. But I I'm beginning to think for the first time that we are going to move towards a housing crash. Now, we're not even close to that yet, so I want to be careful, but I think that's where we're going to end up, with a housing crash. And that means home prices, I've talked in the past about existing home prices being about 25% above what we would call normal affordability trend lines. And then new home sales are about 10 to 15% above normal affordability trend lines. So I think we have a significant price correction coming in housing. Again, I want to emphasize, I don't believe that ends up as being a huge problem for the banking industry. The banking industry has been very, very conservative in their underwriting standards, but I think it results in a huge negative wealth effect on the consumer. And ultimately, that means we are looking at a recession somewhere in 25, 26. So I just, while the stocks are starting to reflect some of my, negative concerns with the big gaps down, I don't think this on a secular basis is over by any stretch of the imagination. The other group that I highlighted a couple of weeks ago were the mortgage companies, things like Rocket or Compass or UWM Holdings. And I just want to point out, the Mortgage Bankers Association came out with a forecast for mortgage originations, and they're talking about 2.05 trillion mortgage originations in 25, up from 1.779 in 24. That's about a 16% increase. There's no way we're going to do that kind of mortgage originations in 25. So I think these mortgage originators are also very exposed to disappointment. And I think, by the time we get into, February and they revise their forecasts, we're going to see a significant revision downwards. So I think the mortgage finance companies are also worth looking at on the short side. So that's it for housing and mortgages. Ben, did you want to say anything about rates and because that's one area where we could get some relief and therefore a bounce. I don't know if you want to talk about rates.
Right. So I was on a Spaces last night with my bud Dave Levinson. He's been pretty ardent, and I agree with him that what we're seeing first is a flattener. And today we have a massive bear flattener going on, which means the front of the curve yields are up just a little bit, flat top a little bit, but the back of the curve is getting bought hard. And we're now, let me see where we're at the moment, but earlier it was about 25 basis points, the 210 spread. And I think, let's see, here we go. 1 sec, guys. Sorry about that. I'm pulling my Bloomberg up. 25 basis points now. So the long end gets bid. They'll take the duration out of the market because they can see the growth expectations being written down. One of the biggest drivers of that I think tariffs are leading the day in terms of what people are talking about. But if you paid attention this weekend, our boy Elon Musk is out there, he's got a crew and they're just sitting there in the system, figuring out ways to cut spending out of the government. One of the things that they took over was something called USAID, which is how a lot of money flows around. And it can't be that surprising that crypto dumped when this USAID money got pulled out. And not to go too far down that rabbit hole, but the point is if he says they're going to optimistically be pulling out $4 billion a day of spending out of this government, that equates to about $1.2 trillion. Now, let's just give them half of that. Okay, 600. Then every 100 basis points of rate cuts is another 100. And then you get, some offset of that from tax receipts if things go down. So that, some of the deficit will balloon from that. But we have a housing market with a ton of latent equity, to Charlie's point, So we need to get things more affordable. Because right now, I think Charlie's completely been on this and correct, is that nothing's going on. There's just rates are too high, things aren't affordable. And this isn't 2021. 2021, everybody had just spent a year not working. I mean, not working, but not doing the normal stuff. So they've been saving. Government had sent some money. And so there was a lot of juice in personal balance sheets and income then. Well, I think people are pretty stretched. And Charlie's talked about this for a while, and I've talked about this. So the problem with tariffs now is that I think it's a margin hit. And I think it's somebody has to take the hit, whether it's the FX of the other or the other country, or if it's the margins of the importer, the margins of the exporter, and some will be priced in. And we'll get to Bob, but I think that energy will be taking share as a percentage of the PCE basket, as will food. I think if anybody's been to the grocery store, food inflation has continued. That has not. So then what happens is exactly what Charlie's saying, is that you get the high cost durables to just be the loser. So in PCE in general doesn't go up much, but it's a mix shift. And so I think that's what's going on. I think you get the bear flattener, you get the stuff that Charlie's talking about, losing market share and losing demand. You get the stuff that Bob will talk to us about in a minute, taking a larger share, percentage of the wallet share, and pain all around, more or less, And so my view is eventually they'll have to cut rates, and the dollar is going to get too strong, and then it'll allow them, the Fed will get in line. But, it's a process to get there. It doesn't happen overnight. So if we get the S&P down 10 to 20%, let's say, and we get some of these, everyone accepting the government budget deficit that's really been propping things up is going to be less, well, then I think we can get to where the Fed will be cutting, 100 to 200 basis points by June of 2026. So there's an order of operations of these things, and I think Charlie's been spot on with it. And so let's go to Bob now and talk about that energy. Bob,
Yeah.
you want to tell us what you think about the tariffs? You want to tell us what you think about the trade you told me earlier? What do you want to talk about?
Sure. So, tariffs is the big topic, and what Trump did, he knows he doesn't want to run up energy prices. So while he put 25% overall tariffs on Mexico and Canada, on energy from Canada is 10%. So he wanted to inflict a little bit of pain there. And I think that was already partly reflected in the market. But the name I recommended this morning, I put out on the WhatsApp chart that if you didn't own CNQ, to buy it down here below 29. It traded below 30. It traded a little bit below 29, bounced back up here. But I've said all along, I said mid-December, I said a couple of weeks ago, if you get this stock below 30, you buy it. And I've already got, full overweight position in it. So I'm not adding to my position because I'm already full up on it. But if you don't own it, if you're not overweight, I would be buying CNQ here below 30. I see strong technical support at around 29.30. If things get really bad, next support level is 27.50. But right here, the dividend yield is 5.1%, and they will raise a dividend this year. This is a dividend growth company. And whether they raise it here when they report fourth quarter earnings in another few weeks, or they increase the dividend later in the year, they will increase the dividend this year. So this is a name that down here below 30, you want to own it. You want to buy it. If you don't have a position, you don't have an exposure here, you want to be buying CNQ down here. Now, the reason it's getting hit a little bit more than the other energy names, obviously, is because they produce oil in Canada. And so you've seen that the WCS WTI differential widen out a little bit, but not tremendously. It was running around 12.50. It's running 13 and a quarter, 13.50 here. Oil prices WTI wise were up $1 earlier this morning. They're up, between 50 cents and $1. So you're almost getting an offset on the increase in the WTI price to that widening WCS WTI differential. So yeah, that's why they got hit a little bit more. But I think at these oil price levels, you want to back up the truck and buy CNQ below 30 here. If it gets below 29,
it just popped. It just popped. So everyone knows, it just popped like 59 cents. When we started the show, it was 29.50, and I bought it. Thank you, Bob. It's now 30.05 because there was a headline that just popped out that Mexico, they're going to delay the tariffs a month. This is also just very emblematic of the shenanigans you have to deal with Trump. Everyone now remembers the headline bombs that we have to deal with on a constant basis. I will say, Sleepy Joe, it was a little more chill with him than and the erratic nature of Trump. Anyway, keep going, Bob. I'm sorry. I just wanted to put that in there. Thank you for that C&Q, buddy.
Can I just make a trading observation about WTI as well? Because, thanks to Bob, I've been, building, since December, a bigger position in energy, and it's been a nice place to be. But, you had that first pop in WTI crude, from, the high 60s to, 78 or so. And a lot of us thought that was short covering, and it was. And now we've had this pullback, to low 70s, and we're testing the 50-day moving average on WTI. And this is going to be where the real fundamental move is. If we hold here and start to rally, which I think we will, I'm in Bob's camp. I like energy here. This will be the real fundamental move, and that's when the stock should really have a nice run. So that's just a trading observation.
Yeah, and we've had inventories of crude continue to come down, which implies a little bit tighter market than I think everybody was thinking a month or two ago. On the energy side, the next names I'd be looking to buy are EOG and Diamondback on the E&P side. Chevron reported Friday a little bit of a weak quarter due to the refining side of it. So if you're going to buy the integrateds, I'd put Chevron above Exxon here right now, but, I'd be buying C&Q first, then EOG, and then Diamondback. On the gas names, gas is up this morning, up 8-9% just on weather forecast and this continued cold weather. I'm, continuing. I want to buy more EQT and EXE, and I've been patient waiting for a pullback. We haven't gotten it. We'll see what we get it here into March as we get into the shoulder season, but still watching those, hoping to get those, add to my positions in those a little bit cheaper here.
Bob, where in the sequencing of things, where do the offshore drillers fall into place? Because I think one of our compatriots, Robert, had been recommending Weatherford, but that's been not done well recently. So
it's the offshore drillers, they're a little bit lagged to the onshore drillers, the onshore service companies, in the sense that, we've talked ad nauseum about drill baby drill and how that's going to be difficult near term to really force on companies. And as you open up, as he reverses Biden's closing down to the Eastern Gulf and offshore California, Alaska, that's not going to have any impact near term. But getting rid of some of these regulations makes it easier to permit and drill, but it's going to be first on offshore and then offshore. So is anybody going to go out there and step up their drilling in the offshore Gulf of Mexico versus what they planned a few months ago? Near term this year, no.
It's not the Gulf of Mexico, it's the Gulf of America.
I'm sorry.
That's right. Get it right. Google's changed it. It's now the Gulf of America. What a stupid thing to deal with. Gulf of America.
I know all the company. We'll wait to see when the companies change their presentations and when they begin to report here if they change it or not. Everything I'm looking at still says Gulf of Mexico. It's.
Yeah, that would be that. It just derails. That's like a petty Trump thing. Like if someone alerted him to that, he would just start tweeting until you change your company presentation, I'm going to tax you individually, or some stupid shit like that. What a crazy ass time this is. But okay. So Bob, let me ask you a question on this, because I had a buddy talk to me this weekend about pipelines. What's your view on the pipeline impact here? E.T., Williams. Let's talk about that for a second.
We were on, 2 weeks ago? We talked about those and recommended those, and I was buying then E.T. and Kinder Morgan. I think it was last week, 2 weeks ago, I bought both E.T. and Kinder Morgan. I already had a full position in Williams, but this deregulation and is going to have a huge impact on the pipelines. And so we'd be buyers of those just on the fact that you're going to have to transport more natural gas and crude oil at some point, and the whole deregulation part of it's going to open up more of these pipelines to be built, and we're probably going to get Keystone back on the docket at some point here too. So it's a positive, Trump deregulation process, and at some point when people begin to step up drilling, and just on the pipe side, we were buying them before just on the fact that you're going to need all this natural gas for power for all these data centers. That alone is a big plus for all the pipeline companies.
Yep.
Ben, can I riff off of your curve flattener trade and make some observations of how it might affect the banks here?
Yeah, go ahead.
So, if Ben's right about the flattener here, that's not good for bank fundamentals, because the big, draw to the banks in terms of revenue growth this year has been the idea that net interest income is going to ramp up over the course of this year. But behind that was the belief that the yield curve would steepen and banks would have a spread to work with, borrow short, lend long. So if Ben's right, then the curve flattens. I think the banks come in and here in February and maybe even come in hard. And the reason I say that is if you look at the month of January, there wasn't a single large cap bank stock that didn't outperform the S&P 500 except for one, and that one was U.S. Bancorp, where they're in the process of changing the CEO leadership because that stock has underperformed now for 3 years. So they have to, bring in new blood and start to execute. But every other bank stock has outperformed the S&P 500, and on average they were up about 8-9%. Citigroup, by the way, was the best performing large cap bank stock in the month of January, up 16%. But I think even Citigroup could come in here. If it does, I would certainly buy it. Depending on how aggressive this market correction could be, buy it in the mid to low 70s, because I still think that's $100 stock. But I think there's, for trader types, I think there's an opportunity to short some of these regional banks like PNC, U.S. Bancorp, Truist, CFG. I mean, these are all, names that maybe longer term, if you've got a 3-year time horizon, you want to own on weakness. But I think trader types may want to be considering shorting the bank stocks here coming into February.
Basically, I think that we're in a situation where the banks have also had a really nice run, right, Charlie?
Yeah.
I mean, let's just remember SVB was almost 2 years ago now, which is incredible. I mean, I really can't believe SVB was 2 years ago and COVID was 5 years ago. This is just nuts. Time flies when you get old, apparently. And these guys can attest.
We wouldn't know, Ben. We wouldn't know.
But I mean, Citigroup, which just so all the listeners know, Charlie's been a big bull on for a while. And I think that was a very out of consensus call. I think it's been very easy to, not like Citi, let's put it that way, for a while. Yep. But it hit $82 last week, right? And I think you were thinking it was pretty full there. Doesn't mean it can't still work, but that's one of the hard things about our game. You find an idea and then it works, and then it's kind of like, okay, and the problem is that once it's fully valued, the story's out there, but it can continue to work, right? They can continue to do the things that you're talking about. But now what you're saying is that the bear flattener will hurt some of the dynamics present for the banks, independent of the idiosyncratic things that Jane is doing at Citigroup. Is that roughly right?
Absolutely. That's well put. And, and one name, it's interesting if you look back at the performance in January, you definitely saw the money centers and the capital markets banks really outperform the regional banks. And the reason is investors have much more confidence that capital markets revenues have some visibility still right now, whereas the regional banks that are dependent upon net interest income or spread income, there's some uncertainty about the interest rate structures and how that's going to play out. In fact, this week, we have some very important quarterly refunding announcements that Bessent has to deal with in terms of how we're going to term out our debt. So there's a lot of uncertainty on the rate front, and that's what's holding the regional banks back. But within the money centers and the capital markets, I mean, JP Morgan, Wells Fargo, Goldman Sachs, Morgan Stanley, Citigroup, they've all been really, much better performers than the regional banks. The one name that sticks out amongst the money centers that hasn't done as well is Bank of America. And that stock really has underperformed the XLF in the month of January, which is surprising to a lot of us because they've done a good job of inching along, their earnings under the banner of responsible growth. And so, I'm asking myself, what is it that's holding Bank of America back relative to other money center banks? And I think there are two things. There's definitely concerned about some of the unrealized bond losses that they have in their portfolio. It's over $110 billion right now in unrealized losses in their bond portfolio. And that's, concerning to people. While I don't think they'll ever have to recognize that, it does represent some impairment of their capital structure. But the other thing is, I think Buffett continues to sell down his stake in Bank of America, and that's a significant stake. And I think he's intent on getting out from underneath his entire holdings by the middle of this year. So, if he's selling 3 or 5 million shares a day, or 10% of the volume, whatever that is, it's going to be a drag. So B of A is one of those that I just, I like, the fundamentals, but there's some other, as Ben likes to put, idiosyncratic events that is dragging on that stock.
Yeah, I think that's right. And I think that what's difficult right now is that there's two ways to go about things. There's the way of the bottom up, like I'm going to understand what the company's doing and what's in control of the company, whether it's an energy company or it's a bank or it's a consumer company. And then there's this second component, which is the macro component, both international trade from the policy, and then the government spending component, and then there's this interest rate component. So there's a lot going on that's macro oriented that is, like C&Q is a good example, right? Bob's loved this name forever. And I think there was just an assumption built in there that why would we ever tariff energy prices? Like, why would you do that to yourself? I was like, who wants to shoot themselves in the foot? But here we are, right? And so there's I think the analysis on all this has to be two-part. You have to have the macro, and if the macro is too hard, that means you have to just have a lower multiple, right? Like you just need a higher risk premium. And I think that that's what's challenging about this market right now is that the risk premiums are very thin in the market. And these stocks have all across the board for the most part have worked really well. And so, yeah, we're down a little today, but we're coming off like the all-time high last Thursday. And so the Pavlovian conditioning that we've done to investors is buy the dip, buy the dip, buy the dip, and then that's what happens in a bear market. And a lot of people haven't really ever seen a true bear market because we got to go back to 07, 09. And then really the beast was the 00 to 03 one is you buy the dip, it bounces, and then now you got new supply. All the buy the dip guys are now the sellers, right? And so, bear market dynamics are the exact opposite, where you sell the rips instead of buying the dips, and it's a lot harder. Operating in a bear market is a lot harder. So maybe this is the beginning, but if it is, buckle up, because I think that one of the things that this group of people can help with, anybody who's interested is we have a bunch of people been in a lot of markets, and everybody here has been around and seen what happened in the 90s, which is probably the best analog for what's going on right now. The late 90s is probably the true analog for the current market, with the exception being we have a lot more debt today. And there's a few things. Nothing ever is perfect. And so one of the things that, I think is the value of being a subscriber to Wall Street Beats is that we have a group chat that we're opening up to the group or to the people. And if you come on Wall Street Beats, you can come check it out, and, you get access. There'll be morning emails coming to you. And one of the things that's really fun is because we have this group of 10 professionals who've been around, we all chat with each other about what's going on, challenge each other, give each other ideas. And I think that, market that moves as fast as this, it's like, I'm sure everybody likes our morning show, but there's a lot of stuff that comes on the weekend, on the day. So you can get access to everybody's thoughts via the WhatsApp chat. And so come to Wall Street Beats, come check us out. This is going to be an interesting time. If the last couple of weeks are any indication of what 2025 is going to be, pretty sure it's going to be good to have some of these smart guys helping you out. So I think that's all we got for today. Well, it's always fun, Charlie. Fun, Bob. Charlie, I'm jealous of you that you're going skiing. Really wish I was going skiing with you. That sounds fun. Anyway, that's it, guys. Good luck. Keep your head on straight.
Next time.
Thanks, Ben. Thanks, Jen.